Financial Reporting Through the Lens of a Property Casualty Actuary, Part 3, SAP in the U.S., Fundamental Aspects of the Annual Statement. Chapter 14, Schedule F. Overview. As noted in the previous chapter, Chapter 13, Overview of Schedules and Their Purpose, Schedule F and Schedule P are two of the annual statement schedules that property casualty actuaries tend to use most. In this chapter, we will focus on the content of Schedule F. Chapter 15 focuses on the content of Schedule P. Schedule F provides details underlying an insurance company's reinsurance transactions on prospective contracts that meet the conditions for reinsurance accounting as defined in SSAP number 62R. It includes the names of the counterparties to the transactions and the premium, loss, and expense amounts that emanate from those transactions as of December 31 of the reporting year. This information is important to actuaries for several reasons. First, loss and loss adjustment expenses, reserves, recorded by an insurance company include business assumed by the company. Knowledge of the source and amount of assumed reinsurance provides valuable information to an actuary in assessing the reasonableness of the gross and net loss and LAE reserve balances. Schedule F Part 1 provides a listing of assumed premiums and losses by ceding company. Next, loss and LAE reserves recorded on an industry company's statutory balance sheet are net of reinsurance. Considerable focus is placed on the collectability of that reinsurance by users of the annual statement, particularly regulators. In fact, the NAIC instructions to the Statement of Actuarial Opinion require the appointed actuary to provide relevant comment paragraphs to address reinsurance. According to the NAIC instructions, before commenting on reinsurance collectability, the actuary should solicit information from management on any actual collectability problems, review ratings given to reinsurers by a recognized rating service, and examine Schedule F for the current year for indications of regulatory action or reinsurance recoverable on paid losses over 90 days past due. Schedule F Part 3 provides the name of each of the company's reinsurers, a listing of liability amounts ceded to each reinsurer, and the amount of collateral held by the insurance company in support of those liabilities. Using this information, research can be done on the financial ratings of the reinsurers to evidence the credit quality of the reinsurer and assess the risk that the ceding company would not be able to collect the balances due from that reinsurer. Schedule F Part 3 also provides the aging of ceded reinsurance. An assessment can be made of the company's exposure to collectability issues in light of the reinsurer's payment history and the amount of collateral the company holds in support of its reinsured balances. The Statement of Actuarial Opinion also requires the appointed actuary to comment on and disclose the amount of net reserves for the insurance company's participation in underwriting pools and associations. Schedule F Part 1 provides a source for this information. In fact, regulators expect there to be a reconciliation of the amount disclosed in the Statement of Actuarial Opinion to Schedule F. Schedule F also provides the derivation of the provision for reinsurance, which is included as a liability on the statutory balance sheet, page 3, line 16 of the 2018 annual statement. While statutory accounting principles requires insurance companies to record loss and LAE reserves net of reinsurance, SAP also presumes that a portion of that reinsurance is not collectible. The provision for reinsurance provides, quote, a minimum reserve for uncollectible reinsurance with an additional reserve required if an entity's experience indicates that a higher amount should be provided. The minimum reserve provision for reinsurance is recorded as a liability, and the change between years is recorded as a gain or loss directly to unassigned funds, or surplus. Any reserve over the minimum amount shall be recorded on the statement of income by reversing the accounts previously utilized to establish the reinsurance recoverable. End quote. This minimum reserve is computed in Schedule F, Part 3. It reflects the conservative nature of statutory accounting, since the entire provision may ultimately be collected. Schedule F, Part 3 also provides the data used in the calculation of the credit risk charge for reinsurance recoverables required by the NAIC Risk-Based Capital, or RBC, formula. Finally, Schedule F also provides a view of the reporting entity's balance sheet on a gross of reinsurance basis. Ceded reinsurance is a valuable means for insurance companies to mitigate insurance risk. Schedule F, Part 6 enables the user to observe the amount of protection afforded to the company's balance sheet through the use of reinsurance. Note that retroactive reinsurance does not flow through Schedule F. Ceding companies record loss and LAE reserves gross of retroactive reinsurance, and assuming companies exclude the retroactive reinsurance from loss and LAE reserves. The same is true for Schedule P. Retroactive reinsurance does not flow through Schedule P. Structural organization of Schedule F. Schedule F is arranged in the following parts. Part 1. Assumed reinsurance as of December 31 of the current year. Part 2. Premium portfolio reinsurance effected or canceled during current year. Part 3. Ceded reinsurance as of December 31 current year. Part 4. Issuing or confirming banks for letters of credit from Schedule F, Part 3. Part 5. Interrogatories for Schedule F, Part 3. Part 6. Restatement of balance sheet to identify net credit for reinsurance. Parts 1 and 3 provide details underlying the reinsurance items on a company's balance sheet. One asset item and 4 liability items on an insurance company's balance sheet come directly from Schedule F. The asset item is amounts recoverable from reinsurers. Assets, page 2, line 16.1. It includes amounts the insurance company has already paid in loss and LAE to its claimants that are recoverable from its reinsurers. The first of the liability items provides this balance from the reinsurers, i.e., the company's, in this case, as an assumed reinsurer, perspective. Liabilities, surplus, and other funds, page 3, line 2. The other 3 liability items that come directly from Schedule F include ceded reinsurance premiums payable, net of ceding commissions. Liability, surplus, and other funds, page 3, line 12. Funds held by the company under reinsurance treaties, on the liabilities, surplus, and other funds, page 3, line 13, and the provision for reinsurance, which is on the liabilities, surplus, and other funds, page 3, line 16. In addition, the parenthetical reference to unearned premiums for ceded reinsurance in line 9 of page 3 also comes from Schedule F, Part 3, from column 13, the total. Schedule F, Part 3 is used to derive the provision for reinsurance. Effective with the 2018 annual statement, numerous individual parts used to derive the provision for reinsurance were consolidated into a single new Part 3 within Schedule F. This, quote, eliminates duplication, promotes consistency of the reported ceded transactions, provides for greater automation, and reduces filing errors, end quote. The following illustrates how the amounts in the balance sheet map to those in Schedule F using the 2018 annual statement for a fictitious insurance company. While relevant, Parts 2 and 4 through 6 tend to get less attention by actuaries. As the name suggests, Schedule F Part 2 provides the user with a detailed listing of all portfolio reinsurance transactions entered into or canceled during the current year. Schedule F Part 4 provides a listing of issuing or conforming banks for letters of credit as collateral reported in Schedule F Part 3, Column 22. Schedule F Part 5 provides interrogatories for Schedule F Part 3. The interrogatories include two tables with more detailed information. The first identifies the 5 largest commission rates included in the cedent's reinsurance treaties for those contracts where ceded premium is in excess of $50,000. The second table identifies the 5 largest reinsurance recoverables reported in Column 15 and associated ceded premiums, as well as an indicator as to whether the reinsurer is affiliated with the reporting entity. Schedule F Part 6 provides a summarized form of the balance sheet with adjustments to restate it on a gross of ceded reinsurance basis. The assets are adjusted to remove any expected recoverables from the company's reinsurer, while the liabilities are restated to remove any anticipated recoveries or payables. Given the limited level of focus on Parts 2 and 4 through 6 by property casualty actuaries, we will provide only a brief description of their contents and use. We will devote the majority of this chapter to the contents of the other parts of Schedule F, including the calculation of the provision for reinsurance in Part 3. Schedule F, Part 1, Assumed Reinsurance as of December 31, current year. Overview. Part 1 provides the total amount of the insurance company's assumed reinsurance balances by reinsured. It enables the user to obtain an additional understanding of the amounts at stake and risks associated with an insurance company's assumed reinsurance transactions as of the current year. With Part 1, each reinsured is separated into the following groups or categories, with subtotals at the end of each category and group: affiliated insurers, U.S. intercompany pooling, U.S. non-pool captive, U.S. non-pool other non-U.S. captive, other non-U.S. other U.S. unaffiliated insurers, pools and associations, mandatory pools, associations, or other similar facilities, voluntary pools, associations, or other similar facilities, other non-U.S. insurers. Knowledge of the group or category the reinsured is in, as well as the name of the reinsured, provides the user of the annual statement with further insight as to the risk associated with the assumed transaction. For example, the reporting entity may have less control over and knowledge of the risks assumed from an unaffiliated non-U.S. insurer than it would of risks assumed from a U.S. affiliate. In terms of its structure, the first 4 columns of Part 1 provide the ID number, NAIC company code, name of the reinsured, and the reinsured's domiciliary jurisdiction. The ID number is one of the following, as appropriate: Federal Employer Identification Number, FEIN, Alien Insurer Identification Number, AIIN, Certified Reinsurer Identification Number, CRIN, Pool or Association Identification Number. The remaining 11 columns provide the dollar amounts pertaining to the assumed reinsurance transactions, including premiums, loss and LAE liabilities, contingent commissions, and the type of collateral required by the ceding company to secure balances owed to it by the reporting entity. Premiums. The amount of premium written assumed by the insurance company from the reinsurer during the year is shown in column 5. The totals in column 5 will reconcile to the sum of the totals in columns 2, reinsurance assumed from affiliates, and 3, reinsurance assumed from non-affiliates, in Part 1B of the Underwriting and Investment Exhibit, shown in whole dollars. Assumed premiums receivable less commissions payable are shown in column 10. The amount of commissions payable does not include contingent commissions, which are shown in column 9 and discussed below. The amount considered in column 10 is for fixed commissions. For example, if the reporting entity wrote a reinsurance contract for premium of $500,000 with a fixed ceding commission of 25%, all of which was unpaid at the end of the year, the figure in column 10 would be the $500,000 of assumed premium receivable less $125,000 of commissions payable, for a total of $375,000. The total in column 10 is included as a part of agents' balances in line 15, premiums and considerations, of page 2. As we will see later, this is considered in the profit calculation in the IEE. Unearned premium on assumed business is provided in column 11. This is a liability to the insurance company and is included within line 9 of page 3, entitled Unearned Premiums, as well as the unearned premium reserves contained in Parts 1 and Part 1A of the Underwriting and Investment Exhibit. The unearned premium reserves on page 3 and in the Underwriting and Investment Exhibit are net of reinsurance. As such, the assumed unearned premium reserves listed in column 11 of Schedule F, Part 1, make up only one piece of these net amounts. The amount in column 11 should reconcile directly to item 1 within the reinsurance note of the notes to financial statements, titled Reinsurance Assumed and Ceded, which is shown in whole dollars, notes 23C of Fictitious' 2018 annual statement. Loss and LAE liabilities. Known liabilities owed by the reporting entity, i.e. the insurance company, to the reinsured, i.e. ceding company, as of December 31 of the current year, are displayed in columns 6 and 7, with column 8 being the sum of the two. Column 6, reinsurance recoverable on paid losses and LAE, represents losses and LAE that the ceding company has already paid, but for which the insurance company has yet to pay the reinsured. Column 7, reinsurance recoverable on known case losses and LAE, represents the amount of losses and LAE reported by the ceding company as case reserves, for which the reporting entity has included in its direct plus assumed case reserves stated on Schedule P, Part 1, and its net loss and LAE reserves stated on page 3 of the balance sheet. The above information is valuable to the actuary in assessing the reasonableness of unpaid claims. The actuary can reconcile the case reserves relied upon in the actuarial analysis to Schedule F, Part 3, and determine where the ceded loss reserves are coming from. However, Part 1 does not provide assumed IBNR. While a ceding company may report IBNR figures to its reinsurer, the reinsurer is responsible for estimating and recording assumed IBNR. As shown in Table 21, the total in Column 6, reinsurance recoverable on paid losses and LAE, reconciles to the amount on page 3, line 2, reinsurance payable on paid losses and LAE displayed in whole dollars. However, the total in Column 7 does not reconcile directly to any exhibits or schedules within the annual statement. Known case reserves for losses are a part of the reported losses included in Column 2 of the Underwriting and Investment Exhibit, Part 2A. However, LAE would need to be added to this balance to reconcile to the amount in Schedule F, Part 1, Column 7. Contingent commissions. Column 9 provides a listing of contingent commissions payable. Reinsurers pay ceding companies a commission for the premium income generated under the reinsurance contract. Contingent commissions payable represent profit commissions generated from assumed reinsurance contracts that have yet to be paid, as they are contingent on the profitability of the underlying reinsurance arrangement. The total amount listed in column 9 is included within the amount on page 3, line 4, entitled Commissions Payable, Contingent Commissions, and Other Similar Charges. The amount in column 9 should reconcile to item 2 within the Reinsurance note of the Notes to Financial Statements, titled Reinsurance Assumed and Ceded, Note 23C of the 2018 Annual Statement, which provides the amount of additional or return commission contingent upon loss experience or other forms of profit-sharing arrangement as a result of existing contracts, shown in whole dollars. Let's go back to the example we used in our explanation of column 10, assumed premiums receivable. But this time, let's assume that the 25% ceding commission is on a 1-to-1 sliding scale basis instead of being fixed. The 25% ceding commission assumes a 75% loss ratio. If the loss ratio is worse than expected and ends up being 80%, then the ceding commission drops to 20%. If the loss ratio turns out to be better than expected and is 65%, for example, then the ceding commission increases by 10 points to 35%. The amount of assumed premium receivable in column 10 would be $500,000, and the contingent commissions payable in column 9 would be $125,000, which is the amount of expected commission at the onset of the contract. Let's fast forward to the end of the following year and assume that the $500,000 in premium was paid by the ceding company, the reinsured, to the reporting entity, the reinsurer, and the $125,000 in ceding commission was paid by the reporting entity to the ceding company. However, based on actual loss experience to date, the reporting entity now knows that the loss ratio is 65%, as opposed to the 75% originally expected. This means that the reporting entity will owe the ceding company 10 more points of commission, or $50,000. The $50,000 would be shown in column 9 as a positive number and is a liability to the reporting entity. Of course, since the $500,000 in premium has already been received by the reporting entity, the amount shown in column 10 would be 0. Security. The remaining columns of Schedule F Part 1, columns 12 through 15, provide forms of security that ceding companies often require of their reinsurers to avoid credit risk or an insolvency problem with the reinsurer. Funds held. Funds held by or deposited with reinsured companies, column 12, represent an asset to the reinsurance company and a liability to the ceding company. It represents a provision within a reinsurance contract under which a portion of the premium due to the reinsurer is withheld by the ceding company to pay claims. There is usually a limit to the funds held balance. However, it is replenished as or when it is absorbed. Not only do the funds held reduce credit risk, but they also serve to reduce the administrative burden of the reinsured having to go to the reinsurance company to collect each time it makes a loss payment. This provision is often beneficial to the reinsurer as the funds withheld are credited for interest, the rate of which is determined in the contract. Given the benefit, this is one provision that is considered in the evaluation of whether a reinsurance contract transfers underwriting risk. Letters of credit. The dollar amount underlying any letters of credit that the reporting entity is required to post to benefit the reinsured is shown in column 13. Letters of credit are issued by a bank in favor of the reinsured in the event that the reinsurer is unable to meet its obligations. Reinsureds tend to favor this form of credit because it is not part of the estate of an insolvent reinsurer, and therefore not tied up or subject to degradation in bankruptcy or liquidation proceedings. However, letters of credit can be very costly to the reinsurer. First, banks charge the reinsurer a fee, and this fee can be very high in uncertain economic times, as experienced during 2008 and several years thereafter. Second, letters of credit serve as a reduction to the reinsurer's line of credit with a bank, and therefore reduce the amount of collateralization available on its debt obligations. Amount of assets pledged or collateral held in trust. Broadly speaking, these are amounts not otherwise included within the funds held provision. Unlike the other two types of security, funds held and letters of credit, these assets or collateral amounts are under the control of the reinsurer. As we will see in Schedule F, Part 3, the funds held provision and letters of credit serve to reduce a ceding company's provision for reinsurance. Schedule F, Part 1 for fictitious insurance company. Because fictitious insurance company does not have any assumed reinsurance, these balances are zero within fictitious's 2018 annual statement. However, a reconciliation of these balances could be made within the annual statement for another company on the Exam 6 U.S. syllabus. Schedule F, Part 2, Premium Portfolio Reinsurance effected or canceled during current year. Overview. Part 2 provides a detailed listing of portfolio reinsurance transactions effected or canceled during the current year. Portfolio reinsurance is the transfer of policies in force or liabilities remaining on a block of insurance companies' business. Companies tend to enter into these arrangements when they want to discontinue writing a certain business, would like to get the risk or uncertainty associated with the liabilities off of their books, need surplus relief, which can come in the form of the discounted premium. However, these transactions come at a price, as the reinsurer will require a risk premium. The benefit of these contracts must be weighed with the cost. Schedule F, Part 2 for fictitious insurance company. Fictitious insurance company neither affected nor canceled any portfolio reinsurance during 2018. Schedule F, Part 3, Ceded reinsurance as of December 31, current year. Overview. Part 3 is one of the most referenced parts within Schedule F. Part 3 provides a comprehensive listing of the company's ceded reinsurance balances by reinsurer. It shows the dollar amounts related to ceded reinsurance contracts, which enable the user to identify amounts recoverable from each of the company's reinsurers and assessed credit risk. Each reinsurer in Part 3 is separated into the same groups and categories as Part 1, with the addition of protected cells. However, these groups and categories are provided separately for authorized reinsurers, unauthorized reinsurers, and certified reinsurers, with subtotals for each. As we shall see, the categorization of authorized, unauthorized, and certified is used in the calculation of the provision for reinsurance, which culminates in column 78. Schedule F, Part 3 is separated into 5 sections. The first 20 columns detail the ceded reinsurance balances. Columns 21 through 36 calculate credit risk on ceded reinsurance. Columns 37 through 53 provide the aging of ceded reinsurance. Columns 54 through 69 provide the calculation of the provision for reinsurance for certified reinsurance. Columns 70 through 78 provide the total provision for reinsurance, authorized, unauthorized, and total. Ceded reinsurance balances, the first 20 columns of Part 3. Similar to Part 1, Part 3 starts off with a listing of the ID number, NAIC company code, name of each of the company's reinsurers, reinsured in Part 1, and the domiciliary jurisdiction of each reinsurer, reinsured in Part 1. Special Code. Column 5 of Schedule F, Part 3, is used to identify reinsurance relationships of heightened importance to regulators or those where special considerations are made in the calculation of the provision for unauthorized reinsurance. A specifically defined number code is indicated in the applicable row for situations outlined below. Special Code 2. Cessions of 75% or more of subject premium. By definition, an insurance company is a risk-bearing entity. When an insurance company decides to cede most, if not all, of the risk under a contract, regulators need to understand why an insurer writes business and then cedes a large portion of it to another insurer. Column 5 identifies, through an indicator of the number 2 in the relevant row, each individual reinsurance contract whereby 75% or more of the subject direct written premiums are ceded. The purpose of Column 5 is to identify situations where the reporting entity may be acting as a fronting carrier for another company, the reinsurer, in a particular state where the reinsurer is not licensed to transact business. Regulatory concern is that the reinsurer is using the fronting company to avoid regulatory oversight. We often see this in the case of workers' compensation insurance due to the strict licensing requirements. For example, Insurer A may wish to write workers' compensation for a retail organization with locations along the west coast of the U.S. However, Insurer A may not be licensed to write workers' compensation insurance in California. Insurer A may turn to Insurer B, which is licensed in California, to write the policy on Insurer A's behalf. In turn, Insurer B would cede 100% of the exposure to Insurer A. Insurer B would require a fronting fee to provide this service to Insurer A. Certain reinsurance transactions are exempt from this requirement, as they are not fronting arrangements and their purpose is not to avoid regulatory oversight. These transactions include intercompany cessions with affiliates, as these are used to share risks across related companies. Cessions to a group, association, pool, or organization of insurers that underwrite jointly and are subject to examination by any state regulatory authority, or that operate pursuant to any state or federal statutory or administrative authorization, such as a workers' compensation or auto assigned risk pool. Those where the gross annual premium ceded is less than 5% of policyholder surplus, as these transactions are deemed immaterial and may represent situations where an insurance company is exiting a line of business as opposed to a fronting arrangement. Cessions to captive insurance companies, which are regulated in their domiciliary state. Captive insurance companies are used by parent companies, non-insurance, to keep commercial insurance costs down. Special Code 3. Counterparty reporting exception for asbestos and pollution contracts under SSAP number 62R, Property Casualty Reinsurance. Special Code 3 identifies those reinsurers that have been aggregated into one line in Schedule F in accordance with the counterparty reporting exception for asbestos and pollution contracts under SSAP number 62R, paragraphs 66 through 68. This exception allows the provision for reinsurance to be reduced by reflecting that amounts have been recovered by the reporting entity under duplicate coverage provided by the retroactive contract, and that inuring balances from the original contracts are payable by the retroactive counterparty if applicable. In order for this exception to be employed, the agreement must comply with paragraphs 66A through 66E, and the reporting entity must obtain prior approval by its domiciliary regulator. If this exception is employed, the reporting entity must complete the supplemental schedule for reinsurance counterparty reporting exception, asbestos, and pollution contracts. Note that this exception only applies to the calculation of the provision for reinsurance and how these contracts are presented in Schedule F. It does not change the treatment of retroactive reinsurance accounting. Special Code 4. Incurred but not reported losses on contracts in force prior to July 1, 1984 that are exempt from the statutory provision for unauthorized reinsurance. IBNR losses on contracts in force prior to July 1, 1984 and not subsequently renewed are exempt from the statutory provision for unauthorized reinsurance. These contracts are identified by a 4 in this column, with details of amounts provided in Part 2, Question 17 of the General Interrogatories to enable the reader to assess significance. Many of the columns in the first section, the first 20 columns of Schedule F Part 3, are mirror images, albeit with different column numbers, to the corresponding contents of Part 1 for assumed reinsurance, and pertain to premiums ceded, reinsurance recoverable, reinsurance payable, and funds held by the reporting entity. In our discussion of the remaining columns of Part 3, we provide parenthetical references to amounts in Schedule F of fictitious insurance companies' 2018 annual statement, where applicable. Premium ceded. The amount of written premium that is ceded to each of the company's reinsurers during the year is shown in Column 6. The total amount in Column 6, 1,882, the 000 omitted, should reconcile to the total of Columns 4 plus 5 in Part 1B of the Underwriting and Investment Exhibit, which is shown in whole dollars. Reinsurance recoverable. Columns 7 and 8 provide recoverables on paid losses in LAE, $426,000 omitted. These are booked as an asset on the insurance company's balance sheet, $426,000 on page 2, line 16.1, because the company is awaiting receipt of a recovery from its reinsurer on payments that the insurance company already made to the claimant. Columns 9 through 12 provide recoverable on unpaid loss and LAE. The totals of Column 9, 5,343, 000 omitted, will reconcile to the Underwriting and Investment, Part 2A, Column 3, shown in whole dollars. The totals of Column 11, 4,038, 000 omitted, will reconcile to the Underwriting and Investment, Part 2A, Column 7, which is shown in whole dollars. For companies that do not participate in intercompany pooling, Schedule F, Part 3, Columns 9 through 12, are equal to the amount of ceded reserves that are netted against the gross loss and LAE reserves, which result in the net loss and loss adjustment expense reserves shown on page 3 of the balance sheet in rows 1 plus 3. Columns 9 through 12 should also reconcile to the sum of the totals in columns 14, 16, 18, 20, and 22 of Schedule P, Part 1, Summary, as follows. The totals in Schedule F, Part 3, columns 9 and 11, 5,343 and 4,038, should reconcile directly to the amounts in Schedule P, Part 1, columns 14 and 16, 5,343 and 4038, respectively. Similarly, Schedule F, Part 3, Column 10, 258, should reconcile to Schedule P, Part 1, Column 18, 258. Since the NAIC Annual Statement Instructions require Column 10 of Schedule F, Part 3, to exclude adjusting and other expenses. The total in Schedule F, Part 3, Column 12, 503, should reconcile to the sum of the totals in columns 20 and 22 of Schedule P Part 1, also 503. Even if the company does participate in intercompany pooling, the recoverables on known case and IBNR loss reserves should match columns 3, reported losses recoverable from authorized, unauthorized, and certified reinsurers, and 7, IBNR losses on reinsurance ceded, of the Underwriting and Investment Exhibit, Part 2A. Note that Part 3 provides IBNR reserves, as these are amounts determined and recorded by the reporting entity. Recall that Part 1 does not provide IBNR. Part 1 provides case reserve amounts reported by the assuming company from the ceding company. While the ceding company may report IBNR to the assuming company, it is the assuming company's responsibility to book what it believes to be its best estimate. Column 13 represents the amount of unearned premium that will be ceded to an insurance company's reinsurers, 920,000 omitted. This should equal to the parenthetical amount on page 3, line 9 of the balance sheet, 920,000, which provides the reduction to gross unearned premium for the amount ceded. This is a contra-liability to the ceding company. It should also reconcile directly to the amount in Item 1 within the reinsurance note of the Notes to Financial Statements titled Reinsurance Assumed and Ceded, shown in whole dollars, Note 23C of the 2018 Annual Statement. Column 14 is similar to Schedule F, Part 1, Column 9, Contingent Commissions Payable, but Column 14 is from the viewpoint of the reporting entity as a ceding company or reinsured, as opposed to the reporting entity as the reinsurer. Schedule F, Part 3, Column 14, represents the amount of contingent commissions receivable from the reporting entity's reinsurers. The amount in Column 14, 11,000 omitted, should reconcile to Item 2 within the reinsurance note of the Notes to Financial Statements titled Reinsurance Assumed and Ceded, which is shown in whole dollars, Note 23C of the 2018 Annual Statement, which provides the amount of additional or return commission contingent upon loss experience or other forms of profit-sharing arrangement under the reporting entity's existing reinsurance contracts. In the case of fictitious, this amount is positive, which means that fictitious expects to receive additional commission from the companies it cedes business to, specifically good reinsurer and slightly overdue reinsurer, as a result of favorable loss experience. However, the amount can also be negative, which would mean that the reinsurer's experience has been worse than anticipated under the contract, and the reporting entity is expected to return some of the commission already received. Column 15 provides a sum of reinsurance recoverables, whether on paid, an asset, or unpaid losses, a reduction to liabilities, a reduction to unearned premiums, or contingent commissions receivable. Column 16 identifies amounts in dispute that are included in Column 15. Amounts in dispute are those for which the reinsurer has disputed amounts due through formal written notification, arbitration, or litigation. Reinsurance payable. Columns 17 and 18 provide other amounts payable by the insurance company to the reinsurer. All other commissions receivable that are not included in Column 14 are netted with ceded balances payable in Column 17. Column 17, 440,000 omitted, should reconcile to page 3, line 12, ceded reinsurance premiums payable net of ceding commissions, 440,000. Amounts in Column 18, 0, represent miscellaneous liabilities owed to the reinsurer under the ceded contracts, excluding funds held by the company under the terms of the contracts with its reinsurers. Funds held are provided for separately in Column 20. Column 19, 11,061,000 omitted, represents the net amount recoverable from reinsurers and is equal to column 15, reduced by columns 17 and 18. Funds held. Column 20 provides the liability for funds held by company under reinsurance treaties, 170,000 omitted, and reconciles to page 3, line 13, 170,000. This provision is the mirror image of that reported by the reinsurer in a transaction, as described in Part 1. It is used by the reporting entity to protect balances due from the reinsurer under the terms of the reinsurance contract. As we will see in the remainder of Schedule F, Part 3, the liability for funds held enables the insurance company to mitigate its liability for unauthorized, certified, and overdue authorized reinsurance. Credit risk on ceded reinsurance, columns 21 through 36. This section of Part 3 is new in 2018. The information reported in this section is not only used in the calculation of the provision for reinsurance, but it is also used in the calculation of the credit risk charge for reinsurance recoverables for RBC purposes. The calculation is performed on reinsurance balances receivable on reinsurance ceded to non-affiliate companies. Cessions to state-mandated residual market mechanisms, the National Council on Compensation Insurance, federal insurance programs, e.g. National Flood Insurance Program, and U.S. parents, subsidiaries, and affiliates are exempt from this charge and therefore excluded from the calculation. The amount of the credit risk charge is dependent upon whether the reinsurance recoverables are collateralized or not, and the financial strength of the reinsurers. Therefore, the credit risk charge is calculated separately for collateralized and uncollateralized recoverables in columns 35 and 36 respectively. The financial strength of the reinsurers is determined based on the current rating received from an approved rating agency as outlined in the table below, taken from the 2018 NAIC Annual Statement Instructions. Table 22 provides a mapping of the current financial strength rating to an equivalent designation category used for purposes of applying the applicable credit risk-based capital charge for collateralized and uncollateralized recoverables, as provided in Tables 23 and 24 below, from the 2018 Annual Statement Instructions. The equivalent designation category is provided in column 34 of Part 3, Reinsurance Designation Equivalent. The calculation of credit risk for RBC purposes is offset by the liability that has been established for purposes of the reinsurance penalty, provision for reinsurance, in the annual statement, page 3, line 16. Therefore, before application of the credit risk charge, the reinsurance recoverables in column 15 are reduced by the Schedule F penalty provided in column 27, equal to the provision for reinsurance in column 78, to produce column 28, the total amount recoverable from reinsurers less any applicable reinsurance penalty. Column 28 is multiplied by 120% to stress the recoverable in column 29. The total of reinsurance payable and funds held, the total of columns 17 plus 18 plus 20, but not in excess of the stressed recoverable in 29, are applied as offsets to arrive at the stressed net recoverable in column 31. Based on the reinsurer designation equivalent in column 34, the credit risk charge on uncollateralized recoverables, provided in Table 24, is applied to the stressed net recoverable, net of collateral offsets provided in column 33, to arrive at the credit risk on uncollateralized recoverables in column 36. Credit risk on collateralized recoverables in column 35 is determined by applying the credit risk charge on collateralized recoverables, provided in Table 23, to total collateral in column 32, columns 21 plus 22 plus 24, not in excess of the stressed net recoverable in column 31. Note, for purposes of calculating the reinsurance credit risk charge, reinsurance recoverables are reduced by IBNR for reinsurers with Special Code 4 indicated in column 5. Recall, Special Code 4 designates those reinsurers with IBNR losses on contracts in force prior to July 1, 1984 that are exempt from the provision for reinsurance. Aging of ceded reinsurance, columns 37 through 53. Columns 37 through 53 of Part 3 comprise the section on the aging of ceded reinsurance. This section provides a breakdown by age of the paid loss and LAE amounts recoverable from the insurance company's reinsurers that are shown in columns 7, reinsurance recoverable on paid loss, and 8, reinsurance recoverable on paid LAE, of Schedule F, Part 3. Paid loss and LAE recoverables are provided in the following age categories: current, column 37, 1 to 29 days, column 38, 30 to 90 days, column 39, 91 to 120 days, column 40, over 120 days, column 41. The total amount of paid loss and LAE recoverable that is overdue, columns 38 through 41, is provided in column 42. The total amount of paid loss and LAE recoverable that is due, current in column 37, plus overdue in column 42, is provided in column 43. The amount in column 43, 426 in total, 000 omitted, reconciles to the amount in column 7, recoverable on paid loss, plus column 8, recoverable on paid LAE, in Schedule F, Part 3. 426 plus 0 equals 426 in total, 000 omitted. And page 2, line 16.1, amounts recoverable from reinsurers, 426,000, of the annual statement. As stated previously, paid loss and LAE recoverables are assets of the reporting entity. According to the NAIC annual statement instructions, the age of the recoverable is based on the following: the terms of the reinsurance contract, as to when claims are to be paid by the reinsurer, if specified; the terms of the reinsurance contract as to when claims are to be reported by the insurance company to the reinsurer, if specified; or the date when the amount recoverable exceeds $50,000 for a particular reinsurer and is entered in the insurance company's financial accounts as a paid recoverable. If the amount recoverable is less than $50,000 and the aforementioned paid or reported dates are not specified in the contract, then the recoverable is reported in column 37 as currently due. Note that recoverables from mandatory pools and associations are reported in column 37 as currently due. Columns 49 through 50 provide percentages of the overdue balances to total amounts due. Column 49 provides the percentage overdue relative to the total due, column 42 divided by column 43. Column 50 provides the percentage overdue greater than 90 days and not in dispute, column 47 divided by columns 46 plus 48. And column 51 provides the percentage overdue greater than 120 days to the total due, column 41 divided by column 43. These percentages are used in the calculation of the provision for reinsurance. Provision for reinsurance for certified reinsurance, columns 54 through 69. In 2012, the NAIC added a third facet to the authorized and unauthorized categorization of reinsurance in Schedule F, called Certified. This resulted in the addition of a new Part 6 to Schedule F, shifting the former Parts 6 through 8 to Parts 7 through 9, respectively. In 2018, numerous individual parts used to derive the provision for reinsurance were consolidated into a single new Part 3 within Schedule F, with columns 54 through 69 being specific to certified reinsurers. Certified reinsurers are non-U.S. reinsurers domiciled in a jurisdiction designated by the NAIC as a qualified jurisdiction, i.e., Bermuda, France, Germany, Ireland, Japan, Switzerland, and the United Kingdom, that would have been categorized as unauthorized prior to 2012, but have applied for and attained certification from the reporting entity's domiciliary state as a certified reinsurer. A non-U.S. reinsurer that is not certified is required to post 100% collateral for its U.S. claims. Once a reinsurer is certified, it is allowed to provide a reduced amount of collateral for its U.S. claims. In attaining certification, consideration is made for the reinsurer's jurisdiction, financial position, amount of capital and surplus, regulatory history, financial strength ratings from recognized rating agencies, among other factors. Once certified, the reinsurer is given a rating that ranges from 1 to 6, called the Certified Reinsurer Rating. A reinsurer with a rating of 1 is considered most secure from a financial strength perspective. A reinsurer with a rating of 6 is considered vulnerable. The rating defines the amount of collateral that the reinsurer is required to post with the reporting entity. The more secure the certified reinsurer, the less collateral required. For example, a reinsurer with a rating of 1 is not required to post any collateral. A reinsurer with a rating of 6 is required to post 100% of total recoverable due to the reporting entity in collateral. The rating and collateral are used in the calculation of the provision for reinsurance in column 77 of Schedule F, Part 3. The obvious benefits to this new certified category are twofold. 1. The reporting entity does not get penalized as much as an unauthorized reinsurer in the provision for reinsurance. And 2. The reinsurer does not have to post as much security with the ceding company. The provision for certified reinsurance comprises two parts, one coming from column 64 and the other from column 69. Column 64 provides the provision for reinsurance ceded to certified reinsurers due to collateral deficiency. This provision is equal to total recoverables from certified reinsurers offset by any corresponding payables from Schedule F, Part 3, Column 19, in excess of the amount of credit permitted for recoverables based on the certified reinsurer rating, Column 63. The amount of credit permitted is based on the amount of collateral actually posted by the reinsurer relative to the amount of collateral required based on its certified reinsurer rating. For example, if a certified reinsurer has a rating of 6, then the reinsurer is required to post 100% of the recoverable in collateral. However, if the reinsurer only posts 75% of the total collateral required, then the reporting entity would record a provision for reinsurance in Section 1 equal to 25% of the recoverable. The 25% represents the deficiency in collateral. 75% represents the amount of credit permitted. Column 69 of Part 3 provides the provision for overdue reinsurance ceded to certified reinsurers. As with authorized and unauthorized reinsurers, overdue reinsurance ceded is defined as recoverable on paid losses and LAE more than 90 days overdue per columns 40 and 41. As we will see, the provision for overdue certified reinsurers is calculated similarly to the provision for authorized reinsurance, in that the provision is greater for slow payers, i.e., those certified reinsurers where the percent of recoverables on paid losses and LAE more than 90 days overdue is 20% or more, than non-slow payers. In the case of slow payers, instead of 20% of the recoverables on paid losses and LAE, the maximum amount of the recoverables on paid losses and LAE and the net unsecured recoverable for which credit is allowed is considered. In either case, the provision is not to exceed the amount of credit allowed for net recoverables per column 63.